Welcome to the week in YouTube Finance. We're talking tariffs today. We're talking Bitcoin on the rise. Let's go check it out. Come on.
Stock markets surged after President Donald Trump announced a 90-day pause on sweeping tariffs against global trading partners on Wednesday. The tariffs had caused the stock market to tumble for several days prior to the announcement. On Truth Social Wednesday, Trump announced the pause on what he called reciprocal tariffs because, quote, more than 75 countries have called representatives of the United States to negotiate trade deals, and Trump's stated willingness to negotiate. During this 90-day period, a substantially lowered reciprocal tariff of 10% will be in effect for negotiating countries. However, there's a key exception: China. Trump accused China for a, quote, lack of respect, and its imports will not benefit from this pause. In fact, China's imports will face a 125% tariff rate after imposing retaliatory tariffs. Several countries have already indicated their desire and plans to negotiate, including South Korea, Israel, the EU, and Japan. The Nasdaq surged more than 10% following Trump's announcement, while the S&P and Dow Jones surged 8% and 7% respectively, recovering from a slide in points experienced Monday and Tuesday. Trump's pause on tariffs comes after his aides had previously claimed the president was not open to making deals, let alone pausing tariffs entirely. Trump trade advisor Peter Navarro has similarly suggested the tariffs are not up for discussion, writing in an op-ed Monday for the Financial Times, quote, "This is not a negotiation," even as Trump himself suggested he was willing to make deals hours later. JP Morgan Chase's chief executive Jamie Dimon told Fox Business that trade deals are complex and lengthy endeavors that, quote, can't be done overnight. This interview took place Wednesday before Trump's tariff pause. While Trump has initiated discussions with some countries, political reports that many others, including those in Southeast Asia, have not yet been contacted about negotiations. Treasury Secretary Scott Bessent has not provided a timeline for these negotiations or indicated if the 90-day pause could be extended. Do you think Trump will stick to his 90-day tariff pause? For more on these stories, check out Antonio Pequeño's and Allison Durkee's articles linked in the description.
Thank you, Forbes.
President Trump just flipped the stock market because he paused tariffs for 90 days on many countries, and the stock market boomed at a rate we have not seen in more than a decade. The S&P 500 rallied by more than 9.5%, and the Nasdaq jumped up by more than 12%. But it wasn't a very straightforward day, so let me break down the timeline, because in the morning on Wednesday, President Trump announced a new 50% tariff on Chinese goods, raising the Chinese tariffs up to 104%. And then China responded. They said that they're going to raise tariffs on the United States up to 84%. And then President Trump responded. This he did on Truth Social. He said, quote, "I am hereby raising the tariff charged to China by the United States to 125% effective immediately." So it went from 104% up to 125% because of the Chinese reciprocal tariffs. And then President Trump went on to say this, quote, "Conversely, and based on the fact that more than 75 countries have called representatives of the United States, and that these countries have not, at my strong suggestion, retaliated in any way, shape, or form against the United States, I have authorized a 90-day pause and substantially lowered the reciprocal tariff during this period of 10%, also effective immediately." Essentially saying that he has put a pause on the big tariffs. He's brought down the tariffs to 10% on all of these 75 countries as a way for President Trump and these other countries to renegotiate their trade deals. And we will ultimately see what happens. And this created a ton of controversy. It created a ton of confusion. And Wall Street absolutely loved it, with the stock market booming, which means if you were buying the dip earlier in the week, well, you got to see a nice bump. But chances are it's not going to be straight, clear roads ahead, because there's going to be a lot of volatility ahead as we start to figure out what is going to happen with these tariffs and the reciprocal tariffs in the coming 30, 60, 90, and 120 days. So let me break it all down. And again, yes, we break all this down in Market Briefs. Market Briefs is my free financial newsletter, where every day my team is working to break down what's happening in things like the economy, the stock market, the housing market, crypto, and the global economy into a fun, witty, and easy to read newsletter. It's completely free. We have hundreds of thousands of investors that read Market Briefs every day. And when you join Market Briefs, you'll also get a free masterclass on investing your money and building wealth in this financial system. So if you want to join Market Briefs for free and get the masterclass, all you have to do is click the link down in the description below. A tariff, again, is a tax, and it's paid for by the recipient. So if you are a company that imports products from China, and now you have to pay an additional 125% to bring those goods into China, it has become extremely expensive. It means either A, you're going to find a different country to manufacture products, or B, you're going to move the manufacturing back into the United States, which is really the ultimate goal of President Trump. We see that not just through the tariffs, but also through the tax plan, because if you've watched my tax video, you know that the tax proposals right now are going to A, punish you if you manufacture your products overseas, because you'll have to pay higher corporate taxes, and B, reward you if you manufacture your products in the United States, because the new tax proposals have lower corporate tax rates if you manufacture products in the United States. All of that sounds like good news to bring jobs back into the United States, to bring manufacturing back into the United States. But of course, it doesn't come with a very clear path. As we can see, tariffs have created a lot of controversy and a lot of downward momentum in the stock market. We've seen a lot of people panic, a lot of people freak out, a lot of people sell, and a lot of businesses get worried about how these tariffs are going to impact the economy, how they're going to impact inflation, and how they're going to impact just the general markets, which has caused all this volatility that we've been seeing, because the tariffs make doing business more expensive if you have a global presence. And if you're a business and now you have to suddenly pay a whole lot more money to bring your products into the United States, and you can't absorb all that higher cost, well, then you might have to raise your prices, which normally wouldn't be that big of a problem. But the reason why it's a problem right now is because we've already been facing so much inflation, and so many consumers have already been struggling paying their bills as it is. So the risk of higher inflation in the short term due to tariffs has a lot of businesses concerned how they're going to continue selling their products, how they're going to continue to make money and stay profitable, which has led to all the confusion, all the worries, and all the concerns in the stock market and the economy. Even the Federal Reserve Bank has come out and said on multiple occasions now that they believe that the tariffs would cause at least transitory inflation, which is why they don't know what they're going to do with interest rates, because they want to not be too aggressive either way, to let the economy do its thing and then ultimately make a decision after that. Well, now with this pause, we have even more uncertainty, because time and time again, we kept hearing that there's going to be no pullback on tariffs. We had this rumor a little while ago where Bill Ackman tweeted that the United States government should consider a 90-day tariff pause, to which the White House responded saying that it was fake news, that it's not going to happen. And now here we are with some sort of 90-day pause. But it's not a complete pause, because there's still the 10% baseline tariff. However, it's not as extreme as it was. The interesting thing is going to be what negotiations come out, because the information that we have tells us that there are many countries, dozens of countries, that are now willing to negotiate with the United States on what these trade terms are going to be. What does that ultimately look like? We have no idea. We don't know how favorable it will be. We don't know what it's going to look like. We don't know what's going to happen in the coming 90 days. Chances are, when those 90 days end and tariffs are started again, that it will create more volatility in the market. Why do I say that? Because while history doesn't exactly repeat itself, it does rhyme, and this is something that we've been seeing month after month after month. Let's go back to February 2025, not that long ago. But if you remember what happened in February, that was when the first talks of tariffs really became reality. It was tariffs on Canada, Mexico, and China. And as soon as those tariffs became a real thing, we saw markets immediately drop. But then after the markets fell, there was a 30-day pause put on those tariffs, where there was some renegotiating done between Canada and Mexico, and a little bit with China, but not so much. And then after the 30 days ended, of course, the tariffs were reinstated, which then created another drop in the markets in March. Well, then there was another pause put on, and then there was all this talk about Liberation Day coming in the beginning of April, and then markets kind of took a breather and decided, Liberation Day is not going to be that bad. It might only be 10% tariffs. And then came April 2nd, Liberation Day, and of course, the tariffs that were placed were much stronger than originally expected, which caused the markets to fall at a rate that we haven't seen in many years, which created more panic, more anxiety, but also created a buying opportunity for some people that were willing to go against the grain, who were long-term investors, which of course we've been talking about here. And so now we have this information that tariffs are going to be paused for 90 days, and we don't know what's going to happen in the next 90 days. Chances are there's going to be more volatility. Chances are there's going to be more negotiation. Chances are we could see big movements up and down. But this goes back to the core principles that we've been talking about. Stay calm. Be a long-term investor. When you're a long-term investor, all the noise is just noise. And if you have good investment opportunities, all you want is a good buying opportunity. And now you just got to know your game. If you are a passive long-term investor, you're investing your money into, say, the S&P 500, you're buying a piece of the total stock market, you just want to own broad exposure to the economy, you just follow something like ABB, always be buying. You follow a system every week, every 2 weeks, every month, no matter what. Through the craziness, through the ups, through the downs, you just keep buying. And you can see through the YouTube comments of everybody talking about how you would be a fool to buy stocks in this market. You would be a fool to buy stocks when things are going down. Nobody knows what's going to happen tomorrow. Nobody thought that tariffs were going to be paused. Nobody knows what's going to happen. Nobody knows what the Federal Reserve Bank is going to do. Nobody knows if we're going to enter a recession and it's going to get much worse. But if you know that you believe in the American economy and you want to own the economy for the next 10 to 15 to 20 or 30 years, you just follow a system where you keep buying. And the only time you change it is when you see big drops. You could use it as an opportunity to potentially buy even more aggressively. The alternative is to be more of an active investor, not a trader, but an active investor where you're looking for more specific niche opportunities. Maybe it's a specific stock, a specific company that you want to invest in, but now you're doing the research to keep up with the company. You're studying the financial statements, you're studying the company, and you're looking for a shift. You're looking for an opportunity that you believe is going to be worth more in the future because you believe that the economy is changing in this direction. You think AI is going to change the world. You think data centers are going to change. You think whatever industry is going to change, and you find a good stock, and now you're just looking for a good buying point. As an active investor, it takes more time, more effort, more research, but it also comes with more potential reward at the price of more risk. More risk because, well, you could be wrong and you can lose everything. But if you're right, you can also make a lot more money. And now you just have to know your game. We know that wealth is built through investing, period. That's what wealthy people do. We know that recessions happen, period. We have seen 16 recessions in the last 100 years. We know that market crashes happen, period. We've seen 25 bear markets, 25 stock market crashes in the last 100 years. They're going to continue happening. Recessions are going to continue happening. And if that's news to you, well, welcome to this channel. Recessions are going to keep happening. We're going to continue seeing market crashes, and we don't know what's going to happen tomorrow. But if you know your strategy, then you can stick with it. You can cut through the noise. You can cut through the financials and find opportunities, because guess what? Some people made a ton of money yesterday. Some people were very angry. Well, at the end of the day, it doesn't matter really how you feel. The question is, what are you doing about it? Because there's one question Wall Street is always asking: where is the money moving? And we don't know if the markets are going to keep going up. There's a good chance that we're going to see more volatility upwards and downwards. We could see the markets move significantly lower. We could see a market crash happen soon. We could see a recession happen soon. We could see a lot of things. But if you get caught up in the day-to-day, and now you start changing your investment decisions based off of what's happening in the day-to-day, it is going to very much hurt your ability to build wealth. That's why you have to start thinking like an investor. And that's where, hopefully, Market Briefs can help you stay a little bit calmer, to be able to find the opportunity through all of that noise. And with that, I will see you on YouTube tomorrow.
Imagine walking into a real estate office and seeing the price tag on a brand new apartment, 0.001 Bitcoin. Or picking up a week's worth of groceries for your family for a few thousand Satoshis. Sounds insane. Maybe. But if you're thinking in fiat terms, you might be underestimating just how far Bitcoin's purchasing power could go. So what will 1 Bitcoin buy you in 2045? In today's episode of Bitcoin Backstage, we break down Michael Saylor's open source Bitcoin 24 model to see where he thinks Bitcoin will be in 20 years. And we go backstage with the immutable Jeff Booth to talk about how Bitcoin can unleash prosperity beyond its value in today's dollar terms. Let's mine deep. Michael Saylor argues that Bitcoin is digital capital, the first asset that perfectly stores economic energy. Unlike fiat, which bleeds value through inflation or real estate and stocks, which are tied to debt and counterparty risk. Bitcoin absorbs global wealth without dilution. That's why he predicts Bitcoin could reach 13 million per coin by 2045. Sounds insane. It's not. That only requires an average of 25% annual growth, way less than Bitcoin's historical norm. But if Bitcoin absorbs that much value, what happens to everything else? We've been conditioned to believe that prices always go up. But what if that's a lie? What if prices aren't rising? What if our money is just getting weaker? Jeff Booth, entrepreneur, investor, and author of The Price of Tomorrow, explains that technology naturally makes everything cheaper. Computing, energy, manufacturing, and medicine, automation, and AI are swallowing entire industries, cutting costs at an exponential pace. If left alone, this would make life dramatically more affordable. But our current financial system fights this trend. Instead of letting deflation benefit the people, governments print money and borrow against future growth that may never come. They inflate away debt, but in doing so, they steal the benefits of deflation from everyone else. When we say Bitcoin fixes this is what we're talking about. Thanks to Bitcoin, capital can simultaneously be more productive while also driving increased productivity gains. Combine that with Bitcoin's mining energy infrastructure benefits, and you've got the recipe for a Bitcoin-driven productivity boom that could reshape society. Even in the short term, since Bitcoin's launch, what once cost 100 Bitcoin now costs 10. What once cost 10 Bitcoin might soon cost just 1. This isn't a crash, it's a realignment. Bitcoin exposes how distorted prices have become under a fiat standard, which brings us back to the question, what could 1 Bitcoin really buy you in 2045?
Our assumptions, well, Bitcoin's currently 22 basis points of the global economy. That's $2 trillion. Over 20 years, right now it's been growing about 60% a year. If it decelerates from 60% a year to 20% a year, the average return is going to be 29% a year over the 20 years. That is the base case. That arrives at a price of $13 million a Bitcoin in USD terms, or $280 trillion in the network.
When the money printer goes burr, fiat loses buying power. You know it, I know it, and more people are waking up. But in the US, most places don't accept Bitcoin yet. If you're stuck spending dollars, at least stop earning fiat rewards. The 2% Fold Bitcoin Rewards credit card lets you earn unlimited Bitcoin back on everyday purchases. Saylor's math suggests Bitcoin's market cap could reach 250 trillion, absorbing value from real estate, gold, bonds, and stocks. If Booth is right, and technology keeps making everything cheaper, and Saylor is right, and Bitcoin absorbs global capital, then Bitcoin's purchasing power won't just increase. It will redefine wealth itself. So why should you care? Because most people are still trapped in fiat thinking. If Jeff Booth is right, and we're headed for a battle between artificial monetary expansion and the natural deflation of technology, then Bitcoin isn't just an alternative. It's an inevitable replacement. If Saylor is right, by 2045, 1 Bitcoin might buy more than just a house. It could buy an entire neighborhood, a lifetime of energy, or wealth that lasts generations. Together, they paint a bright orange future powered by Bitcoin. Now, let's go backstage with Jeff Booth at Bitcoin Mena.
So, considering the rapid development of AI and automation, what role do you see Bitcoin playing in the future of work and the global economy?
So Bitcoin resolves the paradox that the free market is deflationary. Every bit of the the work that entrepreneurs do to try to create value has to compete against what came before it. And AI is no different. It competes against what came before it, which was not AI. And so if you're using AI and another company is not using AI, the other company is going to go broke. Your company is going to go broke to the new person that's using AI at a lower and lower cost. So that process would drive abundance to all of us if it allowed prices to fall to all of us, and it would consolidate all of the gains from AI to control us in the other system. So in Bitcoin, it resolves the paradox. And if you're measuring in Bitcoin, all of prices, that's why I say Bitcoin isn't going up. Prices are falling against Bitcoin because now you're in the system that you should have always lived in, where the free market is in service of you instead of a system that extracts that gain from you and consolidates it in very few people.
So in a deflationary economy, like the one you predict in the price of tomorrow, prices would come down in perpetuity, but wouldn't wages as well? And how do you think people would adapt to this? Would we be negotiating the size of our pay cuts?
Yeah, so that's actually a really interesting thing. The existing system works because people don't realize inflation is wage deflation. So their wages are going down, and they're in economics, they call it wages are sticky, because we don't think about the money being manipulated underneath. So we don't think we have to ask for his raises as fast. That is the thing that concentrates wealth and power in very few people, and everybody else gets destroyed. If wages are sticky, it works in reverse. Your employer is forced to ask you to take less wages more often, and it works exactly in reverse. It's a boom for the middle class and poor, because the employer doesn't want to lose you as fast, and so you have the negotiating power.
A lot of the barriers for many Bitcoiners is the education and how to use it. It's complicated. Like, let's not kid ourselves. Like, when we try to self-custody, how do you explain that to your 80-year-old grandma? It's not as easy to use. What do you see it happening in Bitcoin in order for us to reach mass adoption? And if we do you think everybody's going to self-custody eventually?
So I think people should self-custody. At some point in the future, Bitcoin will touch 8 billion people on this planet. Not might touch 8 billion people, and it will touch 8 billion people on this planet. And as that does, it's really what ends up happening in Bitcoin is Bitcoin doesn't change, you change, right? And you understand, and you start to understand that we've always lived in a world of extraction and exploitation, and you don't have to anymore. You can move your time and energy to a world of cooperation that benefits all humanity. So it's inevitable that people make that switch. And all of these ideas or different ways that people teach, different tools to bring more abundance, are just more and more ways that this transitions across time and space. But it's going to take a long time because it's not Bitcoin that needs to change. Bitcoin is imposing the free market, a global free market on all of us. And if you want to live in the other system, it's going to get worse and worse and worse, which makes the opportunity in Bitcoin better and better and better.
How do you think it's going to happen, though? Are people going to, because there's a whole lot of commotion, especially like on Twitter, and when you talk to Bitcoiners, they tell you not to spend your sats. Like, what would you say about that?
I spend my sats every day, and then I replace them. So I am actively engaged in building the world I want to see. That doesn't mean other people have to. They can see Bitcoin whatever way they want. They can hold their sats. If they want to hold it on an exchange and take that risk, they can do that. Isa, if you asked how you came into this or how I came into this, I once lived over in a world where I thought the world, that exploitive world, was normal. And it took me some time to really understand Bitcoin, to be able to get deeper and deeper and deeper. And as I got deeper and deeper and deeper, I went through the same process that most people went. First, I want to just hold it as a store of value. First, I held it on an exchange. Then self-custody. Then, wait, this is more than that. And as I got deeper and deeper, my time moved more into Bitcoin. I think that path is the same thing for every single person on this planet.
US tariffs against China add up to 145%.
Is America heading towards a recession?
The Dow's down more than 1,000 points as that global sell-off intensifies.
We're in uncharted, unprecedented uncertainty.
I think it could get worse if we don't make some progress here.
President Trump is urging Americans to stay cool.
What's up, you guys? It's Graham here, and I hope you're prepared for what's about to happen. Starting right now, the United States has implemented a 145% tariff on China in response to their 84% tariff on the United States. So as these tariffs kick in and seemingly increase by the day, we're soon about to feel some substantial and immediate impacts throughout our entire economy, from the price of everyday items, to the stock market, to the unemployment rate, to even the interest rate on your mortgage. Yeah, seriously. That's why, given the severity of what's going on, as well as all the misinformation floating around on the internet, we gotta talk about exactly what's happening, the impact that's about to be felt throughout our entire economy, what this realistically means for you, and then what you could practically do about this to put yourself ahead no matter what happens. Because even though we all can't be like Warren Buffett and hoard $350 billion worth of cash, there are some practical steps that you could take today to put yourself in the best position possible long term over these next few days, weeks, or months. Although before we start, as usual, if you appreciate videos like this where there aren't any hidden agendas or biases, just the facts, it would mean the world to me if you hit the like button or subscribe if you haven't done that already. Seriously, it does help out the entire channel tremendously, and it's totally free. As a thank you for doing that, I will do my best to read and reply to as many comments as I can. So thanks so much, and also a big thank you to Rocket Money for sponsoring this video, but more on that later. Alright, so as a bit of a background, in terms of what's going on and why the situation seems to be devolving so quickly, let's start here. China. Even though a lot of these headlines have seemingly appeared out of nowhere, the reality is, over the last 40 years, China has been at the forefront of production, international investment, and rapid productivity, all because of an exchange that occurred back in 1979, which gave China diplomatic relations with the United States. Countries from around the world invested their money in Chinese infrastructure, they took advantage of low-cost labor, and they helped bring much-needed funding to areas that were previously closed off. In fact, China's growth was so impressive that in 2001, they became a member of the World Trade Organization as a way to help further strengthen ties with the United States. But it didn't exactly go as planned. For the United States, it became quickly apparent that demand for low-cost, cheap goods was increasing way faster than expected. More and more products were being outsourced elsewhere, and corporations moved 6 million jobs overseas to allow for higher profits. Now, even though this certainly did bring down the cost of nearly everything that we use today, for China the benefits were monumental. With all of the worldwide trade and foreign investment, 400 million people were lifted from poverty. In addition to that, their economy is now 11 times larger today than it was in 2001. They became the world's largest exporting nation in 2009, and they were even touted as the world's economic miracle while they grew at a faster pace than any other nation. However, not everything was exactly as it appeared on the surface, because the more China grew, the more powerful they became in relation to every other nation. The more leverage they had within their own businesses to control them, the more they could change policy in any way that they deemed fit, and the more difficult they'd become to join forces with. In fact, members of the World Trade Organization allege that China's been providing illegal state subsidies to businesses who export their products, discriminating against companies who don't buy from Chinese manufacturers, and controlling supply chains through taxing raw materials. Even worse, it said that they've been devaluing their own currency by as much as 40% as an incentive for other countries to buy their goods at a discount, leading, of course, to some of the tensions that we see today. So what does this mean for tariffs? Well, here's where things get really interesting. On the surface, we export $143 billion worth of our goods to China that they buy from us, but we import $438 billion worth of goods from China that we buy from them. Or in other words, we buy 3 times more from China than China buys from us, leading to a trade deficit that the Trump administration wants to get rid of, or at least negotiate with tariffs. Initially, this started out with Trump proposing a 20% tariff on Chinese imports back in March. In response to that, China implemented an additional 15% tariff back to the United States across a variety of food products. This, of course, resulted in Trump retaliating with a 54% tariff back on China, which resulted in China escalating to an 84% tariff back in the United States, and this is where everything completely fell apart. On April 9th, Trump announced a 90-day tariff pause across all countries, with the exception of China, and instead, the United States increased China's tariff to 104%. China refused to back down once again, and at the time I'm recording this video, tariffs have now been increased to a whopping 145%. In fact, China recently went on record to say that if the US insists on further escalating its economic and trade restrictions, China has the firm will and abundant means to take necessary countermeasures and fight to the end. Or I guess put another way, this is becoming a real-life game of chicken to see which country is going to bow down first, and it's unclear exactly how this is going to end, especially if one country puts tariffs on another in response to their tariffs, in response to their tariffs, until everything falls into the abyss. This has resulted in several estimates predicting that the cost of an iPhone produced in China could soon increase by $800, or 67%, while an iPhone 16 Pro assembled in India could see just a $45 increase. To make matters worse, this applies to all shipments without any exemptions. For example, in the past, shipments under $800 were exempt from tariffs since those were mostly sold consumer to consumer. But now that's no longer the case, and even Amazon has recently said that the most likely outcome is that these tariffs result in increased prices for customers. Of course, China's responded to all of this by saying that they are open to negotiating, but it needs to be based on mutual respect and equality. Although our Treasury Secretary recently said that he believes China doesn't want to come and negotiate because they're the worst offenders in the international trading system. They could raise their tariff, but so what? This leaves us with the realization that this is either a art of the deal negotiation that is going to result in a once-in-a-lifetime opportunity, or it's a situation that's about to get very messy very quickly. Although in terms of the impact this is going to have on you, you're 100% going to want to hear this. Although before we go into that, look, it's no surprise. Now let's get back to the video. Alright, so in terms of the realistic impact this is going to have throughout America, let's talk about price increases. As it stands right now, nearly 14% of everything we buy comes from China. They're our second largest trading partner, even above Canada. But in terms of what China buys from the United States, it's also pretty substantial, at 7%, meaning China buys more from the United States than they buy from any other country. This implies that both countries, to a certain degree, are reliant on each other for their economies to run smoothly. Of course, for the United States, there are some significant benefits of trading with China, and this is why our imports have increased more and more over the last 30 years. For example, first, we get access to lower prices. In fact, a 2019 study found that increased trade with China boosted the annual purchasing power of the average US household by $1,500 between 2000 and 2007. Second, exports from China supported over 1 million jobs in the United States, or about 0.5% of the entire civilian workforce. In this case, American companies can earn tens or hundreds of billions of dollars from China that they could then reinvest back into their US offices. The same applies to China, who's invested tens of billions of dollars in the United States. Third, we also benefit from China's hyper-specialization. The thing is, China's very, very efficient at heavy industries like steel, machinery, or assembly line production, way more than the United States, and doing those jobs domestically would be a huge waste of time and resources. And fourth, we could get access to China's growing population. Like as of 2025, China makes up 17% of the entire worldwide population, and a large portion of those people have now been lifted from poverty while consuming more goods and services. For instance, keep in mind that more than half of Facebook's revenue is from overseas. 67% of Apple's business is generated from outside of the United States, and even Tesla is collecting 25% of its revenue from China alone. But it's also not without a bit of a catch, because there are downsides. Unfortunately, first, this does result in job losses throughout manufacturing. For reference, in 1970, about a quarter of American workers held jobs in the manufacturing sector, and today it's only about 8%. Now, many people would argue that this is probably for the best, since they'd rather work in an air-conditioned office than an assembly line, and our workforce has changed significantly over the last 50 years, but there is the goal to bring some of those jobs back to the United States to benefit our workforce. Second, there are national security concerns. Even though this isn't exactly a financial issue, policymakers have been worried about the possibility of spreading disinformation and collecting sensitive data throughout America. This is the exact reason that TikTok was scheduled to be banned, and intelligence agencies have raised concerns about China's involvement in the tech industry. Third, we have another one that impacts almost everybody, and that would be currency manipulation. As I mentioned earlier, it's rumored that China purposely devalues their currency as an incentive for other countries to buy from them. This allows them, in turn, to purchase US dollars. And finally, fourth, we have labor violations. It's no surprise, but many have been very critical about the working conditions that allow us to buy very inexpensive goods and services, usually working people to exhaustion 7 days a week. Of course, not every factory is in violation, and many of them provide a fair wage and reasonable hours. But for those who work in the industry, it's still evolving. This suggests that the situation isn't so black and white, but rather a constantly changing ever-changing dynamic of ups and downs, and in terms of how this is going to impact you, we need to talk about the trade deficit. Even though it seems like we're getting ripped off because we buy more from China than they buy from us, it's important to give context because there's a lot more to the story, and trade deficits aren't always a bad thing. Like, consider this. Here in the United States, we have $163 trillion worth of wealth with a savings rate of just 4.6%, compared to China's $84 trillion of wealth and 44% savings rate. See, culturally, a lot of China's of the mindset that money should be saved, not spent. As a result of that, they consume a lot less, and that leads to some of the trade imbalance that we've noticed recently. It's kind of like saying person A spends almost all of their money, and they're 5 times richer than person B, who saves 40% of their money. So it's natural that person A consumes more from person B than person B buys from person A. In this case, it isn't so much of a trade deficit, but rather fundamental differences in the mindset when it comes to saving, consumption, and spending. And frankly, if you enjoy a lot of the cheap items that you use on a day-to-day basis, it's in large part due to China's ability to produce those items very quickly and cheaply. Now, on the bright side, as severe as 145% tariffs might be, keep in mind that this doesn't mean that all products from China are going to increase by 145% in terms of what you pay. That's because this price increase is purely tacked on to the value of the products at the time they're being imported, not the price they sell for. So as an example, let's say China makes a shirt for $2 and sells it to a US wholesaler for $6, who then sells it to you for $30 at retail. In this case, that 145% tariff is applied to the $6 price paid by the wholesaler, not to the $30 price the retailer sells it for. And if the retailer passes on the entire cost of the tariff to you, a 145% tariff on $6 increases the price of your $30 shirt to $44.70. In terms of how all of this is going to play out, I'm going to be honest. I've had to change this a few times while filming the video because things are evolving so rapidly, and all of this could change on a moment's notice. But in terms of what Trump recently said, we'll see what happens with China. We would love to be able to work a deal. We're resetting the table, and I'm sure that we'll be able to get along very well. I have great respect for President Xi. He's been, in a sense, a friend of mine for a very long period of time, and I think that we'll end up working out something that's very good for both countries. So far, with some of the stock market sell-off and recent economic uncertainty, things are looking overall better, with Canada agreeing to drop tariffs tomorrow if President Trump agrees to do the same. But China's begun negotiating terms with Europe on their own deal, which could increase leverage against the United States. Although in terms of my own thoughts, for whatever that's worth, here's my take on things. Overall, it is important to consider that over the last 80 years, our dollar's been used as the world's reserve currency. So even though we do have a trade imbalance, we do provide financial services for the entire globe, and a lot of them own and buy our national debt because it's seen as very stable. Like, no one ever has to worry about not getting paid by the US government because they've never defaulted on their obligations ever in history. And if they were to do that, well, I'll save that for another video. Anyway, this reliance on the US dollar makes it so that other countries actively buy our treasuries, and it gives us the low, attractive interest rates that we've become very accustomed to. However, over the last few days, we've seen the 30-year treasury yield skyrocketing higher, meaning most likely other countries are having to sell US debt, driving down the price and the yield up. Or I guess more simply put, demand to buy US treasuries is going down, so interest rates have to go up to entice enough people or countries to buy into them. This is all very concerning because the higher that US treasury yields move, the higher interest rates on mortgages get. And we all know what that means. To me, this signals that either some very big players are losing their confidence in the United States and pulling their money out, or they're being forced to sell. I honestly have no idea which one it is, but it's something to pay very close attention to. Objectively, we do risk losing favor with the rest of the world if we can't become a reliable, stable trading partner. Worst case, this trade war causes other countries to reduce their reliance on the United States and move their manufacturing elsewhere because we've become slightly more unpredictable. Of course, best case is that we negotiate some really good deals and everyone moves on as normal, but that could also take some time. And even if we do come to an agreement, manufacturing is not going to change overnight. Generally, it's going to take years to move jobs and processes from one country to another, or even for some of that investment to yield any sort of significant return. And there's also the possibility possibility that the next administration could run back a lot of these policies without a guarantee of sticking around. Businesses don't want to outlay a lot of capital and work for something that isn't guaranteed to stick in place, and a lot of that uncertainty is going to cause them to probably remain on the sidelines for longer than expected. Now, don't get the wrong idea, because I do think that tariffs can be the right situation in certain circumstances. Like Biden quadrupled tariffs on electric vehicles made in China, tripled those on steel and aluminum, and doubled the duty on semiconductors, so that their imports wouldn't destroy what we're able to do here in the United States. But the outcome of today is going to dramatically depend on whether or not this escalates, or whether or not they come to a deal relatively quickly in a way that benefits everybody. In terms of what you could do about this, honestly, I think it's a great time to cut down on your expenses, live below your means, invest long term, and pre-buy what you might need over the next few months, even though I have a feeling it's probably not going to come to that, but just in case, if you're able to. Realistically, I just can't help but think that the most likely outcome is going to be a pause on Chinese tariffs for a certain amount of time to give them enough room to negotiate. But then again, what do I know? I'm just a dude in a half-converted garage making YouTube videos, and the situation changes so quickly that I have to change this video a few times while filming it so that it's completely updated. If you want to stay up to date on all of this, by the way, please make sure to subscribe and hit the like button if you haven't done that already. I'll do my best to keep you updated every step of the way, so if you subscribe, you're not going to miss out on anything that I post. Thanks so much. Let me know your opinion in the comment section, and until next time.
Thanks, Grant. Do me a favor, like and subscribe so we can find each other again, get to hang out, learn about the business that's around us. Thank you.